Hello, this video on income gap analysis shows how banks are able to measure the impact of interest rate changes on their net interest income. Now though, net interest income is the key measure of bank profitability and is calculated as the difference between interest income and interest expense. Gap is the difference between the dollar amount of assets that mature or are repriced within a specific period. These are called rate sensitive assets, and the dollar amount of the corresponding liabilities, which are called rate sensitive liabilities. So here you see the definition for income gap. And to calculate it, we're first going to have to identify the assets and liabilities that will be affected by a change in interest rates in each period. The period within which gap is calculated could be daily, weekly, monthly, quarterly, annually, and stuff like that. So to demo that, we have here this mini case showing the balance sheet of a certain bank, and the first thing that the analyst is going to have to decide upon is which period during which to calculate gap. So in this example, income gap is going to be calculated based on rate sensitive assets and liabilities that mature within a year. So the analyst has picked out the rate sensitive items in blue right here, and there are additional items that only a portion of them are going to be accounted for in this calculation. So some of these are summarized right here. So for the rate sensitive assets, they're going to include all assets maturing within a year, variable rate mortgages and stuff like that, and a portion of mortgages. The analyst has determined that approximately 20% of them are going to be called in within a year. And on the other side of the balance sheet, the rate sensitive liabilities will include all of these items. And checking and savings accounts, they have determined that only a portion of them, as shown here, will be accounted for in the calculation. So pulling all the numbers together, the rate sensitive assets come out to be $32 million if these are in millions, and the rate sensitive liabilities, adjusting for the portions with respect to checking and savings accounts, come out to be 49.5 million. So as you can see, the rate sensitive assets are less than the rate sensitive liabilities by 17.5 million. And so what we are facing here is a negative gap, and that exposes the bank adversely to an increase in interest rates. Say for example, if interest rates were to go up by 5%, so what that means is that interest income is going to rise by 1.6 million, which is 5% of this 32 million right here, while interest expenses are going to go up by 2.475 million, which is 5% of this 49.5 million. So as you can see, net interest income actually is going to go down by about $875,000 because, as you can see, fewer assets are repriced at the higher interest rate than there are liabilities. Now, by the way, knowing that our income gap here is a negative 17.5 million, we can determine directly the change in interest income, in net interest income that is, by simply multiplying the rates change by gap, which in this example is 5% of this 17.5 million negative. And so that gives us the amount. So to summarize right here, if gap is negative, in that rate sensitive assets are greater than rate sensitive liabilities, then as you can see, if interest rates go up, this will lead to a reduction in interest income and of course also net interest margin. Net interest margin is going to be your net interest income divided by your interest earning assets. So I'm going to summarize this on spreadsheet so you see how that shakes out. All right. So in this simple example, let's say that that a certain bank has rate sensitive assets equaling $40,000 and rate sensitive liabilities equaling $50,000. So as you can see, we're facing a negative gap. So if interest rates go up, interest income will rise by 180, which is basically, all right, what I did there was click here, the change in interest rate of 0.45% multiplied by rate sensitive um, assets, and do the same for liabilities. And as you can see, we are facing a negative change in net interest income. So that's not good. By the way, if on the other hand, change in interest rate is on the negative side, if we expect, for example, interest rates to fall by 1.2%, then as you can see, interest income is going to drop by 480, which again is simply going to be equal this 1.2% multiplied by 40,000, and then you do the same by multiplying this by this $50,000 in rate sensitive liabilities. So as you can see here, yes, interest income will fall by 480, but that fall is less than the drop in liabilities, because as you can see, this gap is liability sensitive. So as a result, actually, net interest income will rise by $120,000, all right? Well, 120 really, all right, which is the amount by which the drop in interest income is below the drop in interest expenses. So now, but watch what happens if we have positive gap. So let's say that rate sensitive assets comes out to be, shall we say, $75,000, all right? And let's use the same number on this side also, $75,000. So as you can see, automatically this says positive gap. I use the if statements to make it change automatically. So we have a positive gap. So our rate sensitive assets exceed our rate sensitive liabilities by 25,000 bucks. If interest rates go up, then that means that more of our assets are going to be repriced at the higher income, giving us a little bit more change than what we're going to pay in interest expenses, making our net interest income to rise by 113. But if, on the other hand, given this positive gap of 25,000, we face a reduction in interest rates, that's not going to be good, because as you can see, we're going to be earning $900 less in income and paying only $600 less in liabilities, because this gap is asset sensitive. So this causes our net interest income to drop by 300. So quite an interesting situation, isn't it? So let's go right back here and summarize everything we've learned so far. If gap is negative in that our rate sensitive liabilities exceed rate sensitive assets, we found that when interest rates go up, interest income is going to go up. However, it's going to go up less than interest expenses. Proportionately, more liabilities, which are larger, are being repriced at the higher interest rate, and this is why net interest income drops. If, on the other hand, interest rates go down, interest income is going to go down, but less than interest expense, causing net interest income to rise. So that puts a smile on our face there. Now, if on the flip side we have a positive gap in that rate sensitive assets exceed rate sensitive liabilities, then what happens is when interest rates go up, interest income is going to go up, and it's going to go up more than interest expense, since proportionately more assets are being repriced at the higher interest rates, causing our net interest income to sweetly rise. Now, if sadly interest rates were to go down, then interest income would fall, and it's going to fall more than interest expense, because again, we're repricing more rate sensitive assets than we are rate sensitive liabilities, which would cause our net interest income to go down. And as you would imagine, if we have a zero gap in that the two are the same, then that tells you that equal interest rate changes are not going to have any effect on net interest income, since changes in interest income are going to be exactly the same as changes in interest expense, and this is going to cause our net interest income to be immunized, to be insulated, that is. And by the way, for good measure, you can see that happen right here. So if I switch this to 50,000, you can see that change in net interest income is 0. Likewise on this side, all right, 50,000. So even though we have a drop in interest rate here and a rise in interest rate there, change in interest income is going to be 0. And that's it.